What's up, everybody? It is Thursday, July 8th. What's going on? So we had two nice up days in the stock market, and kind of encouraged yesterday. Well, first let me start. I didn't get to do a video yesterday, but all right. So Tuesday we had a fiscal drain of about 8 billion. And like I said, I've been telling you guys that every month now, there's really only 5 days a month when we're going to see a net positive liquidity fiscal flow. And those are the 4 Social Security payment days, and those are just going to be small positive flows. And the big one, like what happened on July 1st, that's the first of month payments. And July 1st was a really big one, all right? That was, I think it was like 120 billion or something like that. I told you guys about that. So remember last week, I said we're going to rally into the end of the week on that big positive fiscal flow. And then it'll continue into this week. And then I said it'll stall out. So far, it hasn't stalled out. The good news is that yesterday, actually, when I was expecting to see another small net drain, because now, like I've been saying, taxes are exceeding the fiscal flow, the spending. So it's like whatever's being spent in is getting drained out immediately. But yesterday, we did have a small positive flow. So that was encouraging. That was encouraging. I don't think it's going to last, but that was encouraging. So we're still kind of running on that big liquidity boost that we got from Friday. All right. We had 2 nice days in the market, 2 up days, technically chart wise. And I don't really talk too much about charts and technicals, but I'll tell you that there's still, overhead resistance, the highs that we saw June 27th and June 28th in the S&P and the NASDAQ, the Dow a little bit higher, we have resistance as well. So, we might get through that. For me, the situation remains the same. I mean, if we're going to continue, here, let me spell it out again. Right now, the flows it's like a slow drip, all right? The monthly flows, they will be positive, but at a very low level. Like last month, what did we have? Like a 54 billion deficit. That was the fiscal balance for the government, 54 billion deficit. These are tiny, all right? And I don't think they're sufficient to sustain a positive GDP growth rate, especially with the inflation situation and the fact that that is a net drain. Okay, how does that work? That's because of the trade deficit. That's income that flows out to the foreign sector. So it is a subtraction from our GDP. But I have to say, like yesterday, I was encouraged by that. Even though it was a small positive flow, it's still a positive flow. It's not a subtraction. And the other thing I want to say is that, and I report this to you guys on a weekly basis, bank credit is very strong. I mean, when in the latest data, when you look at bank credit, loans and leases, particularly consumer loans and commercial and industrial loans, okay, so credit to the industrial sector, credit to consumers, very strong. I don't see any sign there of a pullback. So again, you got to understand that if the government is slowing down its net spending, if another sector or increases their net spending at the same time, and in this case, being fueled by not checks going out by the government, but bank credit, that could offset the slowdown in government spending for a period of time. So it's something to keep an eye on. The other thing is this. Now we're starting to finally see some QT, quantitative tightening. Everybody freaking out about that. I'm still seeing a lot of mention and comments about QT, how it's going to cause like a gigantic global meltdown and all this. Meanwhile, stocks are going up, capital investments going up, so I just look at that stuff and I laugh because, again, it's based on a flawed understanding of what QT really is. So now that it's finally getting going, and we saw the Fed's balance sheet in the last 2 weeks, it's down by about 40 billion, which, it's minuscule when you're talking about a 8.9 trillion balance sheet, but now it's finally starting to go in the right direction. Although in the latest week we had a 104 billion increase in bank reserves, and again that was due to the July 1st big first of the month payment. But now that QT is actually starting, it should help sustain bank lending and the bank credit expansion, right? For reasons that I've explained so many times before. When the Fed finally is winding down its asset purchases and in fact, reducing that, it will help to free up space on bank balance sheets, and they could add other assets being loans. And again, the fact that we're seeing loans go up, some people might say, oh, that's a terrible thing, that's a bad thing, people going in debt, but it takes two sides to that equation. You have to have a sufficient amount of credit worthiness. Like, banks are not going to lend if you're tapped out. So the fact that lending is going up, I think, is a testament to the fact that credit worthiness is still, at high levels. That's good. So this thing is sustainable. So what am I saying? I think, getting back to how I characterized it, in prior videos, it's going to be a slow climb back for the stock market. I think the next 2 months, meaning July and August, those are going to be positive flows, particularly in August. August is going to be a big positive flow because we're going to get a quarterly interest payment. But it's going to be a choppy rise. We're going to see pullbacks, but you can buy those pullbacks. And I also think that we're now, for these 2 months, July, August, and maybe even half of September, you're going to see a commodity rebound. All right? Stuff like oil. I spoke about oil. By the way, today was the release of the EIA Weekly Petroleum Status Report. And that showed a big 8.2 million build in crude inventories. Now, you have to understand that the SPR, the Strategic Petroleum Reserve, saw a drawdown of almost 6 million. So what happened was they just shifted the crude from the SPR to the other domestic stocks. But we saw a drawdown in gasoline inventories. We saw a drawdown in distillate inventories. We saw a big increase in gasoline demand, up to 9.4 million, almost 9.5 million barrels a day. We saw a big increase in distillate demand. It's amazing what a small little price decline did for demand. Demand shot up for gasoline. It shot up for distillate, diesel fuel. It shot up for jet fuel. So, that just shows there's a lot of pent-up demand, too. That's another indicator for the economy. Maybe it's not really, contracting as much as the forecasts are saying. Tomorrow, obviously, we get the June job numbers. I don't see any sign in the daily unemployment benefit flows that is pointing to a pickup in unemployment. I just don't see it. So we might come in tomorrow with another very strong payroll number. I think they're looking for something like 390,000. I don't know if we're going to hit 390,000, but it should be solid. It definitely should be solid. What else? Bond yields moved back up a little bit today. I mean, we're still going to see some play in the bond market, although I suspect that yields have peaked and will start coming down gradually. The Fed is going to do a 75 basis point rate hike at the end of this month, at July 27th, and then in September they're going to do a 50, at least this is what the market is forecasting, a 50 basis point hike, and then 25 basis points going out November and December and January, and then a pause in February 2023. At least that's what the market pricing is forecasting right now. So a slow climb back. You got to be patient. Don't chase after this market. We got two and a half good months ahead of us. I think this month and August for sure, and then maybe half of September with positive flows, although, you know, just barely positive. But bank credit should be an additionally positive factor. I think now finally that the Fed is, you know, engaging with the QT, and this is great, and this is what I said going way back. If you recall, I said I can't wait for this to happen because, you know, everybody who was predicting catastrophe with QT, like quantitative tightening, I did a bunch of videos on this. I said that's going to be wrong. They have the wrong understanding of this. And as a matter of fact, QT is not a tightening at all. And it would create a bullish environment for banks. Bank stocks, I still think, are like ridiculously undervalued. Ridiculously undervalued. When you think about how much money the banks are going to be earning just from interest the Fed is going to be paying them to do nothing, I mean, it's like, it's insane. And these stocks are really, really cheap on any basis of valuation. I mean, they're incredibly cheap. So, I mean, you should be loading up on the bank stocks and just sitting back, go play golf for a year or something like that. I mean, you'll do very, very well. So that's the update for today, folks. Hope you enjoyed it. Don't forget to like and subscribe, and I'll see you tomorrow. Bye.